What happens if you sell? On what terms can you roll? Do you need to put up new capital to stay in? Do you not? If you don't, how does dilution work? That you now have to make a Form PF amendment. I think it's within 60 days of the end of the quarter of closing one of these transactions. Borrowing should only be used kind of based on our joint decision that it makes sense. It shouldn't be used in the same way it is in a blind pool fund. They shouldn't be able to be stuffed with distributions in kind and then have the GP calculate its carry based on some formula as opposed to the cash that's actually realized. They're hiring that GP to actually sell the investment and provide them with cash. Sometimes there'll be like equity resets at the portfolio company and single asset deals. When we do these, like we're not just cashing out the old fund, we'll also use this as an opportunity to redo the management incentive plan.
Hi everyone, and welcome to another episode of Women of Secondaries, produced by SecLink and hosted by yours truly. My name is Kristina Kulikova. I am the Senior VP of LP Advisory here at Setter Capital, and I'm absolutely privileged to host Women of Secondaries, where we cast light on the incredible powerhouse women driving this market, and of course their expert views on the secondaries industry as a whole. If you missed our prior episodes, make sure to check them all out on SecLink's video and podcast section, YouTube, Spotify, and catch short snippets of the discussions on SecLink's LinkedIn page as well. On this 12th episode of the show, I'm very privileged to have an incredibly decorated and astutely recognized legal professional sitting down with me to talk about the fascinating world of private fund transactions in their full legal complexity and glory. Led and LP-led secondary deals in particular have skyrocketed, essentially doubling in volume in recent years. And really, the use of a competent, experienced, and informed legal counsel is very often the difference between a successful and a failed transaction. Our guest today has worked on a large variety of those transactions, primarily representing private fund sponsors in connection with the formation, structuring, and negotiation of their investment funds. In addition, she has advised and continues to advise sponsors in connection with complex secondary transactions, including fund restructurings, continuation funds, and the purchase of portfolios of LP funded trusts. She has also been recognized as an expert in investment funds by Expert Guide's Women in Business Law, and in 2024 was recommended for investment fund formation and management private equity funds by Legal 500 US, and recognized as a highly regarded lawyer for private equity funds in the US by IFLR 1000. And the list goes on. I am, of course, speaking about none other than the co-head of Weil's US private funds practice, joining us here from New York today, Ms. Stephanie Srulowitz. Welcome, Stephanie.
Thank you. And your words are very kind.
Well, it's an impressive bio, I must say. I felt honored to have a chance to sit down with you today, so thank you for making the time.
Well, it's a privilege to have the opportunity to have this conversation with you, so thank you for having me.
That's awesome. And just to give perspective to our audience, Weil, which is amongst the oldest law firms operating in this space, was founded, I believe, back in 1931, which means Weil has been providing legal services for more than 90 years now, and growing to approximately, is it 1,200 lawyers in offices, 3 continents?
That's right. Yep.
Wow. And you guys have clearly been a pioneer in the marketplace and, first mover, given the longevity as well in establishing of many significant practice areas as well.
That's right.
Is it corporate litigation, restructuring, tax, executive compensation benefits? Anything else I've missed?
We do pretty much all of it. Not me, but as a firm, we've certainly long been known both for our private equity and our bankruptcy practices, and also have, as you've mentioned, incredible litigation and tax practices, as well as public M&A and other corporate practices as well.
So I'm thrilled to honestly have you on the show today, because I think it's actually most often that law firms pioneer new ways of executing transactions, particularly in sort of less straightforward situations that, require complex solutions that then later become the mainstream way of doing things, and then become widely adopted. And I'm sure you've had your share of experience with that as well.
Yeah, that's what really got me excited about the secondary space, and in particular GP-led transactions and continuation vehicles. I first got involved almost about a decade ago in the space when it was really in its infancy. And at that point, it really was an area of a lot of creativity and a lot of problem solving. And to me, being able to work on transactions that were incredibly complex, trying to solve problems for our clients and helping drive not just legal decisions, but business decisions as well. It was a really exciting area of the law to be practicing in.
And how did you first get exposed to the secondary transaction space?
Not on purpose. I still do some work and have some incredible clients who I do primary fundraising work for. And that's where my roots are, where many people in the space's roots are. And so really the way it started was that I had a long-term client who I'd done work for pretty much my whole career, who reached out and said that because of certain things going on in their portfolio, because of certain prospects they had for their ability to fundraise their next fund, they wanted to explore doing one of these transactions. And at the time, there had really just been a handful done in the industry. There were really very few. And the ones that had been done at that point, unlike now, where they're a very hot type of transaction to be doing and people are excited, any sponsor hasn't done one is looking where in their portfolio it might make sense. At that point, there was a real stigma attached to them. I think that people generally thought that, zombie funds were the types of funds that were turning to this funds that had assets that they couldn't sell, end of life issues, team issues. There were all sorts of dynamics. And I had a client who was a fantastic client, had a lot of exciting things going on in their portfolio, but some real complexity to that portfolio. Just timing wise, they raised the fund kind of pre-Lehman. They did a few deals that their first few deals didn't go great. And then they didn't do a lot for a number of years. So they invested most of the capital out of the fund really late in their investment period. So then they had no capital left and the portfolio just wasn't mature. It wasn't ready for realization. And they needed to be able to do more deals, raise more capital to keep their team together. And so that really brought them to the table to look at this type of transaction. And at first, I was nervous for them because there's a lot of conflicts in these transactions. There's some real legal risk. The SEC was starting to make noise about these transactions, and it wasn't clear what the SEC was going to do about these transactions. But on the other hand, I was excited because it was a really new dynamic type of funds transaction that was happening in the market, and it was super interesting. This one involved a pretty large number of assets, a pretty big portfolio. And so we decided we were going to dive in together and we were going to figure out how to get it done.
And especially if it's, multi-assets right off the bat, and this is your first foray and the GP's first foray, that makes it that much more nuanced.
And a couple of them were like regulated assets, which added this whole other dimension. One of them, I think, was regulated by the Fed. I'm sure you've never done a Fed deal, or I hope you've never had to do one, but getting deals through when you have to deal with the Fed, it's never fast and it's never straightforward. So there were a lot of wrinkles to that first deal that just made it interesting and made me realize kind of how much complexity there could be in these deals, but if you could execute them for your clients, you just brought a tremendous amount of value for them.
Yeah, because they rely on you as the expert in the room, right, to kind of guide them through that. And actually, speaking of your clients, I just wanted to bring attention for our audience to some of the incredible roster of representative clients whom we've had the pleasure of working with. And I assume this is both on the primary and potentially on the secondary side. Weil at Weil, who are all giants in their respective arenas as I look through the list, but, the likes of American Securities, Ascribed Capital, Berkshire Partners, CPP Investments, Crow Holdings, Grey Cliff Partners, ICG, Lee Equity, and the list goes on and on, TPG. And I'm sure that's, a very small subset. And so clearly you've had a lot of experience that you bring to the table and a viewpoint that many may not be able to provide because it also stretches across different types of firms and different scale of firms and different needs that these firms have. And so given the diversity of transactions that you've looked at and the types of diverse clients that you've worked at, has there been a shift that you've noticed in terms of volume or receptivity to GP-led transactions? Let's take, pre-COVID, post-COVID, or any kind of inflection point that you think caused that uptick in GP-led deals.
Absolutely. I don't know if COVID's what caused it, but that's definitely going to, I think, always be the industry's inflection point where they went from being those more stigmatized, more challenging deals to suddenly any guardrails falling off and people being really excited about these, blue chip clients, top names in the industry suddenly being interested in doing these transactions if it made sense for their investors and for their portfolio. So, before COVID, similar to what I was talking about in 2015, I first was working on one of these. You really thought long and hard from a reputation standpoint before you did one of these transactions, because even if it made a lot of sense for your organization and was the best solution for a problem, there was definitely a stigma attached to it. The LPs and the buyers who were in this were super excited about it, but there were a lot of LPs and investors out there who were not in the space who really did not look kindly. And there was just some real reputational risk around engaging one of these transactions. During COVID, the market was super active. Things were super busy. I think the bankers did a really good job of starting to sell these transactions. I don't think it was directly driven by COVID, but everybody was home. So people had a lot of time to, talk to their bankers, get briefed on what they might be doing.
Get creative.
There was I remember spending a lot of time at my laptop from 7:30 in the morning till 11 p.m. for many weeks and weeks and weeks on end. And I think that people just did a lot of thinking about what made sense. And we just started to see a lot more single asset activity at that point, and also just a lot less hesitation. And as I said, you started to see real brand names suddenly jumping into the space, super excited about these deals. And I think there was a recognition that if there was an asset that was performing really well, but in a fund that was getting long in the tooth, that a sponsor wanted to stay in, but it didn't make sense to keep it, this was a mechanism for the sponsor to stay in, but to get their LPs out, should that be what their LPs wanted. If there was an asset that needed more capital, but the fund was out of money and it didn't really make sense to go through a process where their next fund was going to put money in at a totally different valuation, this was a great tool to deal with that. And even with challenged funds, it became less of a stigma because the activity just became so robust. You've seen a lot of new entrants in the last 5+ years on the buy side as well, which has helped. There's a lot of more capital available. And you've seen buyers start to specialize more. You have buyers who are focused primarily on GP-leds in general, and maybe not pan-secondaries, including like LP-led sales. You see single asset specialists. You're seeing some specialists who are focused on like the smaller deals in the market, more troubled assets at a steeper discount to NAV, and others who really just want to invest with top marquee sponsors, really big deals. And so you're starting to see specialization, but that has helped create a place for like all different types of deals to get done.
You said something that made me realize that because this approach to deal execution is somewhat new or developing, or I should say, everybody feels welcome to create and to innovate and to sort of drive something that makes a solution workable, right? Whether it's the buyers or the advisors or the lawyers or the GPs themselves, there's a lot more flexibility and innovation, which wouldn't exist in a tried and true model type of transaction world.
Yeah, that's right. I mean, it's been interesting how you see kind of some of the more structured solutions like preferred equity, which we started seeing around plus shortly before COVID, and even NAV financing kind of getting looped in with this space, because I think figuring out creative ways to either get more capital into portfolio companies or to move portfolio companies around within a sponsor structure, those have all kind of come out of this space, and you have some overlap in terms of who's providing that capital and how they're coming up with creative ways to finance transactions.
And actually, I'd love to dig into that a little bit more. How are you seeing these leveraged or structured transactions, whether it's, deferring purchase price or earnouts, handled in CV transactions?
So I think that, we're starting to see more of that. I see it a little more on the LP-led side still in terms of deferred purchase price, paying purchase price over time. But even in the GP-led space, we've seen some deferred purchase price deals. That's probably the most common. Sometimes in more tricky assets that are maybe not as clear-cut valuation cases, we've started to see some earnouts. We're definitely seeing some more creativity in terms of when purchase price gets paid, how it gets paid, the ability to earn more. I definitely see the earnouts and things that are more performance-driven around more difficult assets, whereas really big deals that maybe are very attractive but are really big, huge tickets, you're more likely to see maybe a portion of the purchase price deferred, maybe a piece of it financed with a credit facility. But it's interesting. I've seen a lot of that really driven by the buyers. I think buyers, because a lot of them are themselves funds, they have IRR considerations and cash considerations. And so, they're driving some of like, okay, so we have the basic deal we put together. Now also how we're going to finance it. We're going to get creative. And they're driving quite a bit of innovation there, which is interesting. It's definitely not the majority of deals yet, certainly on the CV side, but we're seeing those tools used in a number of deals strategically to help, make sure things get done in a way that makes sense for kind of all of the parties.
Yeah, and I think it probably will continue to evolve as more groups get familiar and comfortable with those structures, right? Even if it's, let's say, at an LP level and they've seen it play out and the GP is sort of aware of how that's maybe played out in an LP transaction and can kind of adopt it to a CV.
Yeah. And, I think in terms of considerations, I think, you just want to make sure that if you're agreeing, to get paid down the line and not at closing, like the assets have transferred, you want to make sure who's standing behind that, those dollars. And, a lot of buyers in the space, they use aggregators. A lot of them, again, they have these really complex structures that they come in through. And so they're not necessarily using vehicles with assets as the direct investor, which is fine. But if you have a deferred purchase price, that adds some additional risk in terms of who your counterparty is. So you always want to just be paying attention, thinking about whether you need some back-to-backs or guarantees to make sure that, you don't have to worry that, you're dealing with a shell. I mean, it doesn't come up that often, but I think that it's always good to just be thoughtful as legal counsel to make sure that, you're thinking about the structuring to make sure that, you have real entities you're contracting with. It's one thing if you have, a month between signing and closing, but if, sometimes we've seen deferrals be out a year or more, and you really want to make sure you have, a real entity standing behind that remaining purchase price.
Yeah, no, 100%. And so as I was reading up on you a little bit, I was doing a little Google search. I read that you were recognized as a leading lawyer for fund formation by, I think it was Chambers Global and Chambers USA, and where clients noted, and I quote, she's strong on substance and has a commercial mindset, and her fund knowledge is encyclopedic and is an excellent resource. And what that made me think is, having that commercial mindset from a legal counsel is absolutely paramount to help deals come together, because you're dealing with a lot of stakeholders and, there's contentious issues that come up that you probably are the resolution point. What are some of those most contentious issues that you've seen come up, particularly as they relate to CV transactions from all perspectives?
Yeah, look, I think in terms of things that get contentious, obviously high level terms, how management fee and carry is structured is obviously an incredibly important point. Sponsors, generally speaking, find these deals attractive amongst other reasons, both as solutions for their existing portfolio, but also because of the ability to get economics going forward. And so really making sure there's real clarity around how management fee and carry is going to work from the outset. Sometimes we see clients, they'll kind of set forth the deal in like a 2-page LOI before they loop in the lawyers. And sometimes they think it's really clear what they've agreed. And then when we go to dig in and start drafting the detailed version, things get lost. Like, is the waterfall in a multi-asset deal European or deal by deal? Usually they're European in these, but you want to make sure, you've made it really clear. We need all our capital back before you get carry. You don't want to leave that to chance later. The way things like write-downs work for the management fee, what happens in connection with partial sales. There are certain things that without a lot of drafting, we can kind of deal with right up front. So I think that making sure what the economic deal is really clear up front is really important, because when you don't do that, that can definitely become an area of friction between a buyer and a sponsor when you get into the weeds later. And that's why it's really helpful to have counsel involved early. Some other things we've been seeing lately that are interesting is different philosophies on things like recycling, ability to borrow, distributions in kind. A lot of sponsors on certain terms, they just want to mimic their regular fund. They just like, oh, well, we'll have the same recycling, we'll have the same borrowing provisions. From a lot of buyers in the space's perspective, it's not the same, right? Borrowing should be very strategic here. We know what the assets are, we know what the needs are. We've committed the cash to put in that's needed to go forward. So borrowing should only be used kind of based on our joint decision that it makes sense. It shouldn't be used in the same way it is in a blind pool fund. Like, I've definitely seen there be a disconnect in terms of how people think about that on the sponsor side versus the sell side. Recycling, the ability to recycle distributions. Again, a lot of buyers in the space negotiate an available commitment that is meant to deal with all of the capital that continuation fund should need going forward. the amounts needed for management fees, the amounts needed to pay transaction expenses and operating expenses, and kind of the basket for follow-ons. That dollar amount gets negotiated. So a lot of them don't think robust recycling is appropriate. And then you'll get a little bit further down the line with documents, and often sponsors, they try to pull more ability to pull more cash in. So there can be stress there. And another interesting one that's kind of come up more recently is some disconnect on distributions in kind. This one I found to be a really interesting area that people are thinking about. Usually in a CV, there's one or two lead investors and there may be a syndicate, but it's not a widely dispersed group of LPs like your typical, say, private equity fund, which might have, 80 to 200 institutional investors or even more. Usually here, maybe you have 2 to 5 institutional investors who speak for 90% of the capital. And for a lot of them, they feel that, distributions in kind should really, again, be like a joint decision. They shouldn't be able to be stuffed with distributions in kind and then have the GP calculate its carry based on some formula as opposed to the cash that's actually realized. They're hiring that GP to actually sell the investment and provide them with cash. And so that's been an interesting area where I have a number of buy-side clients that have become pretty passionate that that distribution kind should be something that is jointly decided, or if the GP feels strongly about taking it, if they want cash, they should get cash, and carry should be calculated based on how much cash they get. But definitely an area we're seeing lots of negotiation around right now.
And typically, once you link arms with a GP, do you find that you would advise them on putting these terms, or is it typically only come up at the negotiation point once the buyer has raised this other concerns around it?
I guess the way I would say it is I advise on both sides that before you go into exclusivity, it's really a good idea to enter into a detailed long-form term sheet. This is one of the things that I think has vastly improved in the way these get done as opposed to when I started, which is much earlier in the transaction's life cycle. People don't really try to flesh out not just purchase price, management fee term, and carry, but a bunch of more other important key considerations around the deal, the scope of the reps and warranties, the indemnity. And so I really say at that long form term sheet stage, if there are points that are critical to you as a sponsor or critical to you as a buyer that are likely to be subject to negotiation, it's good to resolve them now. It really helps speed up the transaction as you work through definitive docs and try to get to signing. And it kind of helps spare surprises when, something that's really important doesn't come up till you're negotiating, a 100-page transaction agreement and a 150-page partnership agreement. It makes things a lot harder to resolve. And people sometimes get frustrated with each other because they feel that those key points should have been raised earlier.
Yeah, and something that we see on the advisor side as well. I mean, I sit more on the LP advisory, but we often overlap with our GP-led team, and oftentimes the advisor will be involved. The GP is thinking through their options, and then obviously the buyers are driving some of the creative thought process, commercial terms, etc. And our communication to the GPs is always, you should talk to a legal counsel early so that you understand what's involved here. Of course, the commercial terms everybody can get excited about. Of course, you see a path to a solution for your clients, but is this path actually feasible from a legal, and are you taking on any risk that you shouldn't be taking on by doing that?
Oh, and we appreciate when you refer them to us, because that's the thing. There are a lot of, when you're doing a really conflicted transaction, there's a lot of decisions you're going to have to make as a fiduciary that may be in your best interest and not on your LPs, or vice versa. And you really want to be thoughtful. You really want to make sure you're transparent, and you really want to know, back to what you were saying, where risk lies. So you can decide to take risk strategically as opposed to taking risk kind of haphazardly. And so that's a really important part of our role. It's not to try to talk our clients out of taking risk or making risky decisions, but to understand where risk is and then make the decisions that make sense and are critical to their business decisions, and to avoid risk where it's really not necessary or important to their strategic objectives.
Mm-hmm. And if a GP, let's say, came to you early on in their consideration, right, and they said, okay, what are the typical parts of this transaction that have now become standardized, that sort of the market expects, and this is what we know we're going to be dealing with? Are there certain things you can pinpoint to them?
Yeah, definitely. I mean, I think in terms of terms, purchase price is pretty standard. It's almost, there are definitely exceptions out there, but most of these deals get done based on a relatively recent quarterly NAV. Usually it's a percentage of that, hopefully close to 100% if you're a sponsor. And then usually it's just adjustments for contributions in, distributions out, like dollar for dollar adjustments. So purchase price is pretty standard with exceptions, but generally that would be the expectation. Generally should expect an invested capital-based management fee, something, definitely below 2%. But if it's a performing asset, the basis may be quite a bit higher than whatever it was in your fire fund. And you should expect a tiered carried interest. Carried interest in a typical, private equity or other closed-ended fund is often like a 20% carry over an 8% IRR. It's relatively simple, but in these deals, it's typically tiered. You often still start with an 8% IRR, but usually carry is, in the 10 to 15% range at its first hurdle. Then if you hit, the next IRR hurdle and often a multiple hurdle as well, you get to the next tier. And so usually we see spreads of somewhere between 10 and even up to 25%. It really depends on the transaction. Many cap out at 20, but we do see some premium carry potential in these, but at higher performance hurdles. And so that's another kind of standardized feature. The other thing that's starting to get standardized is just the process. The process, when I started working on these a decade ago, it was a little bit like the Wild West, which made it really hard to get done because people would pick buyers. They hadn't even talked to their lawyers. There were lots of details that hadn't been hammered out. As we've gotten better at, again, getting through long form term sheets, making sure everything that's really important to both sides is agreed early on, it's really helped create a rhythm to the process where, okay, this is an appropriate time to go to the LPAC. This is an appropriate time to sign. This is an appropriate time to go out to LPs and get their elections. And there's a much more standard schedule, a much more standard way of documenting these transactions. There's still lots of room for creativity in terms of what you're trying to achieve and how you do it. But in terms of just like laying out the contours of how you get from hiring your bankers to a closing in a very good way, we have a much more regular cadence to that than when we first started doing these.
And that probably helps to give GPs that have never done this before a sort of play-by-play, right? And they sort of know what to expect of step 1, step 2, step 3, sort of, and the timeline. And actually, you touched on the management fees variability and the carry interest variability. What factors influence that? Is it sort of the quality of the GP, the quality of the asset, the type of buy-side firms that are involved? What dictates the variability in that?
All of the things you just said. I think that the quality of the asset and honestly, the competitiveness of the transaction is going to be the thing that dictates it to the largest degree. If people know that there's a bunch of cooks in the kitchen and they need to put a compelling offer forward, they're going to do so more than if they think they're the only game in town. So that's the most, but there's no question that a sponsor who's very high profile can probably command better terms, even if it's not like the most exciting transaction. And I think smaller, less well-known sponsors are going to be more likely to be terms takers, even if the transaction's exciting. Yeah. But most important is, again, like what the asset looks like and how it's priced and how competitive the actual transaction is.
And do you usually also get involved with notifying LPs or sort of assisting with LP communication and what the GP should think about when they do speak to their LPs, how much detail they should disclose on the deal to increase the likelihood of a transaction?
100%. Look, I think that one of the things that we really pride ourselves is helping our clients not just be mindful of achieving their objectives, but of also keeping in mind things that may not be as obvious if they've never done this before, which is there are regulatory considerations they have to take into account, but also investor relations considerations. Even if you can get a deal done, if you have a lot of unhappy investors who have anchored your funds in the past, it's not a great way to end, even if you get to a closing at a price you like. And so I think helping our clients navigate that, helping them understand when and how they should be communicating with their LPs, helping them put together a fair transaction that keeps their existing fund and its investors top of mind from the very beginning in terms of just giving them good, fair options, helping them also, again, think about transparency, always helping them to remember like they really need to have good transparency, particularly if they're giving their existing investors the opportunity to either roll or sell, right? They're making elections. They really need kind of information parity between the new buying LPs coming into the CV and the selling LPs. And so, we really do help our clients navigate that, think that through. And also really, one of the things we always counsel is early communication is really important. Like you need to talk to your important investors and your LPAC early on, let them know you're thinking of doing this, let them know why you're thinking of doing it, how you're thinking of running the process, and see what their reaction is. You're going to likely need consents to do these transactions. In almost all of these, you need at the very least an LP advisory committee consent. And so you want to know really early if you're going to have a lot of resistance. That's super important.
Yeah, and I couldn't agree more. And it also helps expedite the process at the end of the day, right? Because you're setting it up before rather than during.
Totally. You want to, by the time you get to the LPAC meeting in a totally appropriate way, you kind of want to know the consents there, just because you've given so much information along the way. You already know your LPs support it.
Yeah, 100%. And so let's say if we take away the reputational considerations, right, that a GP has, are there any regulatory or legal hindrances that may come up throughout a process, whether it's tied to the SEC or tied to some asset-specific regulation or anything that a GP might not be thinking about because they're so focused on kind of the relationship and the price element of the transaction? Anything like that to keep in mind?
Yeah, look, I think it's important for sponsors to remember that this is going to be viewed as a securities offering in terms of offering it to, the CV itself, but also in terms of if you're offering your LPs the ability to make an election to sell at a roll. And so, first of all, there's the new marketing rule. All of your materials generally you should assume need to be compliant. Really important to have, again, good legal and regulatory counsel, making sure that you don't suddenly just think of this like a ordinary course sale to a third party where you don't have to worry about your Advisors Act compliance. Here that comes in where it wouldn't if you were just selling this in an auction to a third party. I also think it's really important to note that you now have to make a Form PF amendment. I think it's within 60 days of the end of the quarter of closing one of these transactions. I think the SEC is using those filings to know who's doing these. And I think it's very likely after you close one of these, you will get a call from the SEC asking some questions. And depending on the answers, I've heard rumors, I don't know if this is true, but I've heard rumors that depending on the answers, you may or may not trigger an examination. It's not the end of the world. If you're well advised and you, again, conduct it the way you were supposed to, the fact you might trigger an exam is not the end of the world, but it's something to be mindful of. SEC exams are not for the faint of heart. They are something every single registered investment advisor has to deal with from time to time, but it is something that you should go in with your eyes open that doing one of these transactions, that might be where it ends up. So
an important thing to know early on, or at least keep in your mind early on rather than be surprised by it. Yeah.
Exactly. And I think just in general, you should always be prepared to have investors and or a regulator be asking questions about why you made certain decisions. It's a conflicted transaction. And so you want to make sure that your disclosure is really transparent and fulsome, and that you didn't just disclose the what, but also the why and the rationale. And I think disclosure solves a lot. Like if you're really transparent before you get your LP advisory committee consent and with your investors when they're making their elections, I think you really set up a transaction to be one that hopefully doesn't target a lot of interest beyond just hopefully people feeling good about where it ends.
And so if there's somebody listening in on this, and let's say they're a smaller GP and they have never done anything like this, right? And they're thinking, oh my God, this is so much work, so many considerations. And of course it is, but is there sort of a consolidated play-by-play that they could be like, okay, step 1, check, step 2, check, like anything that you would say, go through this checklist, and that's kind of like from start to finish approximately what you can expect?
I mean, I think that the way it typically works is you typically hire your bankers. That's really where you want to start, because if you have one or more assets that you kind of have in mind, you really want to make sure bankers look at it and think, okay, this is a transaction that is likely to have interest in the market. They have the best sense of whether there's going to be market demand. You then want to start talking to your lawyers to make sure you understand, what do I need to do a transaction like this? Usually, once we get hired, we help negotiate the engagement letter with the bankers. We help do any kind of compliance-related new marketing rule reviews of materials. And then the bankers really run with the auction process. They usually will try to get interest, get a data room open, get bids in. And so there's usually a period of time where you're working with your bankers to line up your CV anchor investors, your lead investors. Once you pick your lead investors, the lawyers usually get looped back in, and we help negotiate a long-form term sheet, ideally, that fleshes out all the material points. At that point, you often will go to your LPAC. That's often once you have the material points, you would put together an LPAC presentation that has fulsome disclosure on what you're doing, on all the conflicts in the transaction, everything from how it was priced, why you're doing it, to what the economics look like on the back end, as well as expense allocations. Like there's a lot of conflicts you need to lay out for your LPAC. And assuming you get your LPAC consent, you then work towards signing. Generally, the two main documents are like a transaction agreement, which is kind of like a purchase agreement and a regular sale, as well as a partnership agreement for your continuation vehicle. Typically, your one or more lead investors will do the primary negotiating of those documents. There may be some other investors who come in to round it out, a syndicate. They usually don't do a significant amount of negotiating. Everyone may want a side letter, just like in an ordinary course fundraise that our clients are used to. And so side letter negotiations are another part of this that usually goes on during the signing process. And once we get through signing, usually we finalize all of our detailed disclosure to the full LP base, which will kind of tell them in detail about the process, about the conflicts, about the terms, and about their options. What happens if you sell? On what terms can you roll? Do you need to put up new capital to stay in? Do you not? If you don't, does dilution work? So we give them a lot of detail on that. They then make their elections. They usually have about a month, 30 days or 20 business days to make those elections. And when those come in, it usually takes a little time to crunch the math, because there's usually a lot of numbers to work through. So I would say we usually aim from the end of the election period, a week to 10 days to get to closing. So it's an involved process, and it's not a process that takes weeks. It's a process that from hiring your bankers to closing usually takes a few months, but it's something certainly that we, in partnering with the bankers, can really help clients who haven't done this before navigate.
If the client hasn't done it before, it's important to surround by those that have done it before, right? And can kind of walk you through that transaction. And clearly anybody who's listening, who's contemplating, call Stephanie. She knows what she's talking about from start to finish. It's important, right? Because I think the more simpler you can put it and really understand what's involved, and then you get into the nitty gritty, obviously, but that's an important one. And you guys have been doing this for a while, right? And you've seen it evolve from start to finish. And then there's been more and more entrants in terms of legal firms that have also come into the market and have represented themselves as being able to act on behalf of GPs for CV deals. And maybe they've done one or two. And there's obviously a lot of kind of cost competition coming in the market on that front. And maybe there's some transactions that work for that. From what I'm hearing from you and from what we've seen on our side, it really does take a lot of experience and a lot of a wide lens of what can go wrong. Do you guys see any of that sort of fee pressure or sort of competition come into the marketplace, maybe from those groups that are less well-versed in these transactions?
I haven't seen a ton of fee pressure from it, because I do think that certainly our clients, both our sponsor clients who are looking to do this even for the first time, who already trust us for our fundraising expertise, as well as our buy-side clients, they understand there's only really a handful of firms out here who have the at-bats and who really know the market, know the complexity, can navigate it. And so while there's always fee pressure on law firms, but I do think that most importantly here, I think our clients really recognize that there's a limited number of lawyers out there who really know how to do these transactions, and hiring counsel who's experienced and efficient and commercial is incredibly important. And so we've had really great success in partnering with our clients to get these transactions done in a way that I think we all feel good about at the end. I do think that there's a lot of barriers to entries for firms who don't have experience in this space, because I think that it's not just the corporate lawyer. You can't just hire one person, right? There's tax complexity to this. I have an amazing tax team who has a lot of at-bats. There's sometimes regulatory stuff that comes in. We now have even like employment teams who've gotten used to helping, because sometimes there'll be like equity resets at the portfolio company and single asset deals. When we do these, like we're not just cashing out the old fund, we'll also use this as an opportunity to redo the management incentive plan. And so we now will be working hand in hand with our employment teams. And so, we're seeing more and more teams really get multiple at-bats, not just my team, but throughout the firm. And I think that there's a real benefit to that, and our clients see that and really value that.
And there's a cost advantage in and of itself in that, because once there's cross teams that get involved from the same organization, and there's workflow and there's communication flow, and it just, same thing when people are working with us, because we have different GP-led team, LP-led team, and everybody's cohesive, right? And it does help if somebody is concerned in terms of costs and how much is this going to, sink into my bottom line. The other point that we've heard groups mention is sort of reps and warranties insurance in terms of streamlining negotiations and helping negotiations and potentially reducing costs. Do you guys see that on your side being a point that's used?
We did some really large deals, some of the earliest deals to take advantage of RWI when it was really not being used a lot a few years ago. And now it's been really interesting to watch a transition where almost every deal we work on is using RWI. There are exceptions, and the exceptions make a lot of sense because, for example, we're working on a transaction where we may not use RWI because the buyer is incredibly familiar with the underlying asset, and they're very comfortable, with the diligence in a way that often, buyers aren't. So there are deal specific reasons we don't see it. We have a few clients who just don't like RWI. They don't think it's worth the money, and so they won't do it in these deals either. But for the most part, we're seeing most deals use it. It really does allow there to be certainty. I think sponsors feel good, even though there's some additional cost to it, being able to have their LPs kind of have a clean break. They're usually very comfortable standing behind excluded obligations and fundamental reps. But for like portfolio company specific reps, they really don't want to go back to LPs and be clawing back distributions. And so I think being able to keep the indemnity simple and really have like a clean transaction has viewed to be pretty valuable. And I think the RWI providers have gotten savvy and made it easy. Now it's much easier to execute and put these in place. And so I think it's been a good development in the industry.
Yeah, I would agree. And I think we're probably going to see more of the peripheral services kind of attach on to make these things more and more streamlined as well.
Yeah, for sure.
Well, thank you so far for sharing all your incredible insights into private capital practices at Weil, but also the market at large, of course, and the very complex inner workings of GP-led secondary market transactions, just because there's so many stakeholders to manage, right? And that's no easy feat on your side by any means. But now jumping to a little bit more of maybe lighter topics, if you will. Sure. So given you were included in Law Dragon's 500 leading deal makers in America, and I think the 2024 Next Generation list, what are some of the deals that you're most proud of?
I would say the deal I'm most proud of in the secondary space is probably the first transaction I did, because I really, at that point it was a new area. I really needed to help my client learn how to do this while I was learning. There wasn't really like a deep bench anywhere where you could do it. And so, it was kind of looking at what was, I didn't know at the time would become a large kind of separate industry, but looking at this funds derivative transaction and saying to my client, like, look, we have been a trusted counselor of yours for a really long time. You guys are an incredibly important client. We'll help you guys figure out how to get this done. And I think we did. And it has been really transformative for their organization. I think 10 years later, it was a really good decision on their part. And I'm really happy to have been a part of that.
Are there any deals on the opposite side of the coin, which, broke down and was sort of like a sore and you kind of couldn't let go thinking about what happened and kind of what caused that breakdown?
I wouldn't say sore like that, because I definitely don't think the breakdown kind of came from our end. But, I did have most deals that we've worked on break down pretty early. It's usually lack of buyer interest. It's usually maybe an out of favor asset like oil and gas assets, and people have just trouble finding demand. So those break down pretty early. You don't have too much invested at the time it's clear they're not going to move forward. I did have one deal make it all the way to the LPAC consent process before it broke down, and it broke down because the client could not get LP advisory committee consent, and that's pretty unusual. And, that one was particularly disappointing because I think the client really did do right by their investors, and I think they really did communicate well throughout. But they had one investor in particular in the LPAC who just made things difficult, and ultimately the deal didn't happen. And I think later on, the investors in that fund probably, if they could have rewound, would have approved that deal and had it happen.
I guess as a benefit, the GP learned the process, and hopefully they could repeat it and come to you to finish it for next fund.
Sure.
So there's always a silver lining, right? Well, just before we let you get on with your day job, I'm sure you have a ton of work to do. I'd love for our audience to get to know the sort of non-legal professional side of you. You ready for rapid fire?
Let's do it.
All right. What's your favorite book?
Cavalier and Clay.
Why is that?
It was just epic and so well written, and I just got totally lost in it. I was an English lit major, and I really do just love a good book that, when you're done with, you're like, you feel like it changed you somehow.
That's awesome. Sucks you in, just like deals.
Just like deals. A little different than deals.
What's the most favorite part of your job?
The most favorite part of my job. I really just love becoming a trusted advisor to my clients. I think that building those relationships and really becoming a partner, not just on legal advice, but on commercial advice, and on really becoming, integral to my partners, my clients' businesses. That's my favorite part of what I do.
And what about least favorite?
Billing time. Has any lawyer at a law firm ever said anything different?
Well, it's understandable.
Yeah.
Well, and lastly, as I understand, you're actually involved quite actively with the firm's inclusion and sort of pro bono efforts, and are co-chair of the firm's task force on women engagement and retention. Walk us through that briefly, and sort of what got you involved with that effort.
Yeah, look, I think it's really important to mentor the people behind you and to find ways to help grow the next generation. I became involved in Tower as a committee member shortly after I made partner. And to me, it was really important, if I was going to be involved in a firm-wide committee, that firm-wide committee be active and thoughtful, and really, because it's focused on women, be about helping women. But to me, it should always be about like helping women in a way that's great for the firm. And so I definitely have helped drive a number of initiatives and programs for the firm that I think have been really beneficial, not just for the women at the firm, but for the firm itself. I'm really proud of some of the things we've done. And I am just really passionate about, finding ways to improve, a great organization. Everything has, needs to look at itself and think about ways it can be better. And I'm just grateful that I can be part of that at Weil.
And I think you're probably a phenomenal mentor to, share your passion with those that are sort of trying to get to where you are and beyond. And that's really important for any organization. Yeah,
I agree. I think mentoring is super important, and it's a huge part of what we do.
Yeah, well, Stephanie, thank you so much for speaking with me and taking the time. And, this has been incredibly insightful for me. I hope the same for our audience. And I'm confident that myself, as well as maybe our listeners, are going to be coming back to you with questions on deal structures and terms and your secrets of modus operandi and getting.
I'd love to hear from them. So
there you go. And we'll definitely link your contact sort of information, how people can reach you once this gets published. And everyone, once again, this has been Stephanie Srulowitz, co-head of Weil's U.S. Private Funds Practice. And thank you for joining us, Stephanie.
Kristina, thank you so much for having me.
It's been a pleasure. And guys, if you've enjoyed watching our episodes so far, we would love to hear from you. Who you'd like to see next on the show, what topics would you like covered? Always, you can send me a PM on LinkedIn. I would love to chat. And as always, watch the Secondary Link LinkedIn page for updates on our next special guest. And I look forward to seeing you in a few weeks, where we highlight the next incredible woman on the Women of Secondaries. Take care.